On January 26, 2026, President Donald Trump stunned global markets with a dramatic announcement that would send ripples through the world economy. In a televised press conference, Trump revealed a sharp and unexpected tariff hike on a range of key South Korean imports, specifically targeting automobiles, lumber, and pharmaceuticals. The news broke across major networks, with headlines flashing and analysts scrambling to interpret the potential consequences. For many, the move seemed to come out of nowhere, catching both investors and policymakers off guard. The tariff increase, which jumped from 15% to 25%, was justified by the Trump administration with claims that South Korea had failed to uphold its end of a crucial trade agreement with the United States. Officials cited alleged violations and imbalances, arguing that the U.S. was simply defending its own economic interests. However, critics quickly pointed out that the administration offered few concrete details or evidence to support these accusations, fueling speculation about the true motivations behind the move. The announcement, vague in its specifics and lacking a clear roadmap for implementation, sent shockwaves through financial centers from Seoul to New York. Traders and analysts scrambled to assess the potential fallout, with global stock markets reacting almost instantly. The uncertainty surrounding the scope and duration of the tariffs only heightened the sense of unease, as investors tried to predict how other countries might respond and whether a broader trade conflict could erupt. The timing of the announcement was particularly disruptive, coming just as Asian markets were preparing to open for the day. In Seoul, financial professionals worked through the night, bracing for a volatile morning. The sudden policy shift left little time for companies and investors to react, amplifying the sense of chaos and unpredictability that now hung over the markets. South Korea's auto sector, a cornerstone of its export-driven economy, faced a direct and immediate threat. Major brands like Hyundai and Kia, which rely heavily on the U.S. market for sales, suddenly found themselves at risk of losing their competitive edge. The prospect of higher prices for Korean cars in America raised fears of declining sales, potential layoffs, and a ripple effect throughout the entire supply chain, from factory workers to shipping companies. The uncertainty left not only investors, but also ordinary Koreans deeply anxious about the economic fallout. Social media buzzed with speculation, while financial news outlets provided round-the-clock coverage. Many worried about the impact on jobs, the value of the Korean won, and the broader stability of the country's economy. For families and small business owners, the tariff bombshell raised difficult questions about the future. As the Korea exchange prepared to open its doors, the world watched closely, bracing for the first signs of the impact from Trump's surprise move. News vans lined the streets outside the exchange, and officials inside worked feverishly to prepare for what many expected to be a turbulent trading session. The sense of anticipation was palpable, with everyone waiting to see just how severe the market reaction would be. The calm before the storm was over. As the opening bell approached, a new era of uncertainty had begun, with the world's eyes fixed on the unfolding drama between the United States and South Korea.
As trading began in Seoul, fears became reality. The KOSPI plunged 1% within minutes.
Billions in shareholder value vanished as automated selling accelerated the drop. Phones rang off the hook as panic gripped the trading floor.
The market's reaction was pure fear. Sell first, ask questions later.
The decline was broad, hitting all sectors and shaking consumer confidence.
For millions of South Koreans, the sudden drop was a personal blow to their savings. The market had been punched hard, and it was reeling.
The auto sector took the brunt. Kia shares fell 6%. Hyundai Mobis dropped nearly 6%, and Hyundai Motor slid deep into the red.
Investors feared higher tariffs would cripple U.S. sales and profits.
Billions in market value evaporated in minutes.
But by mid-morning, the panic selling slowed.
Auto stocks began to recover, clawing back much of their losses by day's end.
Hyundai Motor closed down just 0.81%, Kia 1.1%, and Hyundai Mobis 1.18%. The sector skidded, but it didn't crash.
The worst had been avoided for now.
As the auto sector stumbled under the weight of new tariffs and global uncertainty, South Korea's tech giants seized the moment. Samsung Electronics and SK Hynix, already titans in the world of semiconductors, became the driving force behind a powerful rally that electrified the markets. Their resilience and innovation stood in stark contrast to the struggles of traditional industries, capturing the attention of investors worldwide.
These companies, riding the crest of the global AI boom, found themselves uniquely positioned. While tariffs battered other sectors, Samsung and SK Hynix remained untouched, their products in ever-increasing demand as artificial intelligence swept across industries. Their chips powered everything from data centers to smartphones, making them indispensable in a rapidly digitizing world.
Samsung soared nearly 5%, while SK Hynix leapt almost 9% to a record high. The surge was more than just numbers. It was a signal to the world that South Korea's tech sector was not only surviving, but thriving, even as global headwinds threatened to slow others down.
Investors, sensing the shift, quickly moved their money out of old economy stocks and into the promise of technology. The narrative changed almost overnight. What had been a day of anxiety for many became a celebration for those betting on innovation.
The KOSPI, South Korea's main stock index, not only recovered from its early losses but soared, closing up 2.73%, its biggest single-day gain in weeks. The rally was a testament to the market's faith in the transformative power of technology, and a reminder that innovation can turn panic into opportunity.
The strength of the tech sector didn't just stabilize the market, it transformed fear into optimism and uncertainty into a full-blown bull market. Investors who had braced for the worst now found themselves riding a wave of renewed confidence.
The day revealed a market divided. Old industries, shaken by political turmoil and trade disputes, struggled to find their footing. Meanwhile, new industries, powered by relentless innovation and global demand, surged ahead, redefining what it means to be a market leader in the 21st century.
In the end, it was the tech titans, Samsung and SK Hynix, who saved the day, proving that in a world shaped by silicon and code, innovation is the ultimate rallying force. January 27th became a case study in investor whiplash. Panic in the morning, optimism by afternoon.
Fear drove the initial sell-off, especially in autos.
But savvy investors saw opportunity and began buying the dip.
They bet the tariff threat would be resolved or softened.
As prices rebounded, more buyers jumped in, fueling the recovery.
The day showcased the constant battle between fear and greed in the markets.
Those who sold in panic regretted it. Those who bought the dip were rewarded.
Courage paid off.
Away from the chaos, analysts urged calm, calling the market's panic an overreaction.
Experts argued that South Korea's core companies were strong enough to weather the storm.
Many saw the tariff threat as political theater, likely to be resolved through negotiation.
This analysis encouraged institutional investors to buy back in.
The tech sector's strength reinforced confidence in the market's fundamentals.
Analysts reframed the crisis as a manageable risk, not a catastrophe.
Rational voices helped turn panic into opportunity. The South Korean government moved quickly to contain the crisis.
Officials reassured the public and markets, emphasizing the strength of the U.S. Korea alliance.
A top trade envoy was dispatched to Washington for urgent talks.
The goal: clarify grievances and negotiate a solution before tariffs took effect.
The government's swift response stabilized markets and reduced risk.
Diplomacy became the key to averting disaster.
The prospect of talks offered hope and calmed investors.
Government action was a crucial stabilizing force.
The tariff shock didn't just rattle stock markets, it sent shockwaves through the currency world as well. South Korea's won, already under pressure from global uncertainty, took a sharp dive as soon as the news broke. Traders, spooked by the prospect of escalating trade tensions, rushed to the safety of the US dollar, leaving the won exposed and vulnerable. The sudden flight to the dollar was a clear sign of just how nervous investors had become. And the won's rapid fall was one of the most visible casualties of the day's turmoil.
The won dropped 0.6% in a matter of hours, a significant move for a major currency. For ordinary South Koreans, this meant imported goods, from oil to electronics, became instantly more expensive. Shoppers in Seoul noticed price tags creeping up, and businesses braced for higher costs. The sudden depreciation stoked fears of inflation, as the cost of living threatened to rise. Economists warned that if the won slide continued, it could ripple through the entire economy, squeezing households and companies alike.
The decline in the won reflected deep anxiety about the potential economic fallout. Investors, both local and foreign, watched nervously as the currency tumbled, worried that prolonged weakness could scare off much-needed foreign capital. The mood in financial offices was tense, with analysts poring over data and trying to gauge how far the damage might spread. For many, the won's fall was a warning sign that the trade dispute could have far-reaching consequences beyond just tariffs and trade balances.
In response, South Korea's government moved quickly to calm the markets. Top financial officials held a press conference, promising to monitor the situation closely and take action if needed. Their reassurances, combined with a late rally in the stock market, helped the won recover some of its lost ground. Investors took heart from the government's proactive stance, and by the afternoon, the worst of the panic had subsided. By the end of the trading day, the won was down just 0.3%, still weaker than before, but a marked improvement from its earlier lows. The partial recovery suggested that while confidence had been shaken, it hadn't completely evaporated. The market's resilience hinted at underlying strength but also at lingering uncertainty.
The won's rebound was a testament to the market's ability to adapt, but it also underscored just how fragile sentiment remained. Financial analysts pointed to the quick turnaround as evidence that investors were still willing to bet on South Korea's fundamentals, but they cautioned that the situation could change rapidly if trade tensions escalated further.
Currency traders, meanwhile, stayed on high alert. Many were glued to their screens, tracking every headline and market move, waiting for signals from upcoming diplomatic talks. The uncertainty kept trading volumes high and nerves on edge as everyone tried to anticipate the next twist in the unfolding economic drama.
In the end, the won's fate became a symbol of the broader tension gripping the global economy. Its wobbly stand reflected not just local anxieties, but the interconnected risks facing markets everywhere. A reminder that in today's world, no currency stands alone. The events of January 27, 2026 revealed the speed and volatility of modern markets.
A single political statement triggered global financial turmoil and recovery in just hours.
The market's resilience was clear. Panic gave way to rational optimism.
Investors shifted focus from political noise to long-term tech trends.
The crisis highlighted the power of swift government action and diplomacy.
Dialogue offered hope, showing that calm leadership can stabilize markets.
The day's story was about fear turning into opportunity and the enduring strength of innovation.
For South Korea and global investors, it was a lesson in resilience amid uncertainty.